And I'm one of the few people who don't think interest rates are all that high. Now, it's maybe because of my age and how long I've been around, but prior to the 2008, the great financial crisis, the 10-year government bond yielded in line with nominal GDP. And so if you have real growth of something around 1.5%, 1.75%, you have inflation bottoming out at 3 or 4%, it wouldn't be surprising to me if the 10-year got to 5.5%. It's currently around 4%. That's a minority view.
All right, we have more changes unfolding in the U.S. economy and for corporate America, changes that have real yields beginning to take their toll, as this new note that was put out by a Barclays analyst gives us a look at just how much money firms of varying sizes are being forced to dish out in order to obtain financing, rates that for a lot of people would make them scratch their heads in befuddlement and make most businesses think twice before signing on that dotted line. And we also have Bank of America's September Fund Manager Survey. We like to look at this each month when it's released. We've highlighted it multiple times in prior months, and now with all of these new data points dropping, CPI, jobs numbers, etc., gives us some insight into the thought processes of these leaders who run these giant funds, these asset managers, and where they believe the economy is headed. But before we get started, if you're not already a subscriber of this channel, consider subscribing. It helps the channel out, and I appreciate your support. So the real yield, the rate that actually matters, the difference between the interest rate that you earn on a treasury bond and the rate of inflation, basically how much you're actually earning on your money. Well, that rate is now at its highest level in almost 15 years, and in ordinary times, this would be great. It helps promote a healthy system. The way our system was intended to function, where savers are rewarded, incentivized, and borrowers disincentivized. So many benefits for ordinary people when we have that type of dynamic, right? But not today, not right now. What we have at present are these sudden high real interest rates, which are good, but they are coming off the back of years of ultra low interest rates, where millions of businesses of all sizes were acclimated to ultra low rates. So as good as it is to see real yields rise above 2%, in the interim, we're likely to have some collateral damage accompany them. Here's what this looks like using the 10-year treasury. It's even worse if we look at the 5-year. Now, you can also see this, by the way, in real time by watching the TIPS, Treasury Inflation Protected Securities. And why is this bad? Like for economic growth, I mean, it's because when you have a real yield this high, it means a large chunk of businesses won't be willing to take the risk to grow, to start a new project, to expand. The cost to borrow money is just too damn high, making the rate of return on your investment too low, and therefore the risk of failure that much greater. But there's a second problem with this, folks. What happens to all the businesses who already have loans, already began new projects maybe last year or 2 or 3 years ago, and are finding themselves in a position where those loans are about to reset? Remember, when you borrow money for your business, especially small businesses or mid-sized companies, it's not like the housing market. Most of the time, those loans have floating rates that reset each year or whenever. So they took out that loan, right, on their business with a plan to make a specific return each year. Let's say they planned on a 10% ROI. Well, when their rate resets from 3% to now 12%, what's going to happen? They're in a much dicier situation. So how much do you think a mid-sized business has to pay right now for a loan? We'll take a look at the article published by The Real Economy. Here's the title. The article is called "As Financing Costs Surge, the Real Economy Faces a Reckoning. Rising loan costs are squeezing middle market firms." This was written on September 7th. He writes this: "Rising real interest rates are pushing up the cost of commercial and industrial loans, making it harder for these firms to meet payrolls and finance their expansion. According to a new survey from RSM, the result is a risk to the economic growth across the real economy and potentially even a recession." He goes on and says the survey found that small and mid-sized firms now pay anywhere from 10.9% to 15.5% for financing. Such rates are pushing the risk premiums on loans close to double digits, a dynamic that was hard to even imagine just 2 years ago. And it gets worse. Listen to this part. At the same time, though, more than a third, or 36%, turned to the shadow banking market, 33% to private equity sources, 30% to digital banking and financing sources, 29% to government lending, and a whopping 60% to private lending. Roughly 39% reported using retained earnings and cash to meet financial requirements. Now, in ordinary times, mid-sized businesses should be able to go to their local bank and get a loan, not need to turn to a shadow bank. You only do that if you can't get the loan from your own bank, if they won't lend you the money, and you'd probably try a couple of other banks before turning to alternative financing, right? And the reason is because the rates that you'll pay at a bank are going to be lower than they would be from these private lenders. Well, yesterday, the Wall Street Journal put out an article titled "Almost All Loans Are Bad: Why Banks Aren't Lending." And to be clear, whenever you see or start reading corporate media printing headlines like this, you know it's bad. I'll just read this one data point for you. They write this: one way for American banks to offset the pressure coming from rising deposit costs would be to boost business. More loans, even if earning less individually, could still lead to overall revenue growth. But right now, their lending is expanding very slowly. As of the latest Federal Reserve weekly tally, overall loan growth at U.S. banks has been 3.6% so far in the third quarter, well below the long-term average of 7%. So loan growth has fallen in half, folks, from 7% to 3.5%. But the real tell, in my opinion, will come next month when the Fed releases the sluice, which gives us an idea of how much longer they're going to hold these higher rates. And I don't know about you, I'd personally like to see them remain this high for the long haul. I think it would be the best thing in the long term, even though I doubt they'll have the spine to hold them here for too much longer. But that's just my opinion. Instead, let me give you the opinion of some of the largest asset managers on Wall Street. As Bank of America Global Research just put out their September fund manager survey, this is sent out to 222 people who combined manage over $600 billion in assets. We can see the breakdown of who exactly is answering these questions. There are like chief investment officers and portfolio managers, etc. Now, on the question of the first Fed rate cut, B of A asked them, when will the Fed first cut interest rates? The majority answered second half of next year. 38% say that. Say the second half of 2024. 36% answered Q2 of 24. Only 5% say after 2024. But you could see how their answers actually shifted from last month to this month. Last month, when they were asked this question, 10% said Q1 of 2024. Now that's dropped in half to 5%, which is interesting, seeing even the big guys managing all this money, change their perspective this much month to month. Another example of this actually is the question before. Look at how much they changed their opinions on this one. B of A asks them, do you think the Fed has finished its rate hike cycle? This month, 60% say yes, 33% say no, but last month, 47% said no. B of A rates this: in the past 2 months, FMS investors have shifted from 9 out of 10 saying Fed is not done to 6 out of 10 saying Fed is done. And here's another good question. What do you consider the biggest tail risk to the economy and to the market? The number one answer was high inflation. Answering high inflation would keep central banks hawkish, with 40% answering that way. Only 13% say a bank credit crunch, 13% say systemic credit event, which is actually kind of funny because these folks believe inflation is still the largest tailwind to risk, but at the same time overwhelmingly believe that the Fed is done hiking rates. Strange times, right? All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Press the dislike button. Either way, I appreciate you watching.